All right, hello traders. Are you ready to up your trading game and boost your income? Well, Strangle trading on futures might be the game changer you're looking for. So stick around here. Let's learn some more. I just closed another Strangle a little bit ago, and I'm thinking I gotta show more people this strategy. I don't know why more people aren't doing it. So I'm excited to share some insights on Strangle trading with you today. I'm going to show you how it can potentially enhance your trading strategy. It's one of my two favorite strategies so far here in 2024, and I've now won 31 of 33 Strangle trades in 2024, and we're only 5 months in. I've generated almost $26,000 in income in only 5 months in just Strangle trades without using a whole lot of buying power. So let's get into it and see what we're doing. Let's dive in. And I know as traders, we all face challenges when it comes to maximizing our income. From market volatility to unpredictable trends, trading can be tough. But selling Strangles offers a unique solution to these common dilemmas. Let me share my screen a bit with you and give you a couple insights on what we're doing here. And let's get into it. I'll take myself off the screen just so you can see a little bit better, although maybe I'll leave it there for now. So again, it was 30 of 32, but I just closed another Strangle, so it's actually 31 of 33 Strangles. Like I said, it was 24,954 on the gains, but it's now 26,504. All of that in the last couple hours, adding another roughly $1,500 to the kitty. And I'm only doing it in really 4 to 5 main assets. Okay, we're looking at oil, gold, copper, bond futures. I'm going to cover more in depth about all of those and what we're doing. All right, so let's talk about some common challenges in trading. Number one, market volatility. The market can swing dramatically, making it hard to predict price movements. Traditional trading methods often fail due to these wild swings. I mean, look at the markets today, okay, rocketing up on a good CPI report. Volatility is everywhere, and you never know what's going to happen from day to day. Unpredictable trends. Number two here. Trends can change abruptly, leaving traders exposed to significant risk. Trying to predict market direction and get the timing right is very difficult, and usually is the reason most traders fail. Trying to time the markets, trying to get it right, figure out what the trend is. If you don't know what's going on trend-wise, and you enter at the wrong time, or both, it's going to be catastrophic for your trading plan. And then lastly here, income maximization. Consistently achieving high returns is a daunting task for many. Selling Strangles can offer you a more strategic approach to profit from that market stability or even instability out there, finding the right setups. So if we can help you be more profitable when the market's volatile, help you when you can't figure out what the trend is, okay, and help you maximize your income, it's going to make you a better trader. And consistency is the key to trading. All right, so here's how it works. Okay, let's cover the basics of Strangles for you. What are selling Strangles on futures? Well, selling Strangles involves selling both a call option and a put option with different strike prices, but in the same expiration date. This strategy allows traders to profit from the premiums collected as long as the price of the underlying asset remains within a certain range. The range is the key. You don't have to be right on direction. The asset can move up or down. As long as it doesn't move too much in one direction, the strategy wins. So you don't have to be great at reading charts and market timing and understanding all of that stuff. You just have to pick an area where you don't think the stock can go. And our setup is going to make it super easy for you. So here's how it works. Call options. First off, you're going to sell a call option. Call options give buyers the right to purchase the underlying asset for a specific price before that expiration date. And for this right, they're going to pay you, the seller, a premium that you get to keep. So you're selling away the right to a buyer to actually purchase the stock if it gets to that price. Okay. On the put side, okay, put options. You're going to sell a put option, which gives the buyer the right to sell the underlying asset at a specific price before the expiration date. For selling this right, you're also going to take an income in the form of premium. So you're taking in premiums by giving someone the right to purchase the strike on a call option, and you're also selling and taking a premium when you're giving a buyer the right to sell you the asset on a put side. So by combining these two trades together, we create what's called a strangle, which is going to benefit from market stability, and the premiums collected from selling both of those options are yours to keep no matter what happens. So you're getting paid to just sit there and wait and watch the market hopefully stay within your two strikes, okay? The put strike and the call strike. All right, so understanding the mechanics of the strangle trade. First off, strike prices. The call option strike price is usually set well above the current market price. For me, it's about 9% above the current price. The put option strike is about 10% below the current market price. Okay, so we can move up or down a good 5 to 10% in either direction and still win the trade. Okay? Stocks can go up, stocks can go down. We don't even like individual stocks. What I like trading are futures. Okay, I like trading baskets like the S&P 500 futures. Okay, so now I'm trading a basket of 500 stocks. Okay, not just one stock that can react violently to some kind of news or something that happens out there. Okay, I want something a little bit more stable. 500 stocks is a lot more even keel than trying to trade just one crazy stock out there. Right? So number one, we're going to select those strike prices well below and well above the current price of the stock. Okay? Then we're going to figure out the expiration date. Both options are going to share that same expiration date. I like to go out a few months into the future to give me more time to be right. It also allows me to collect a little bit more premium. Now, I know the common wisdom out there from Tasty Trade and others is maybe selling 45 days to expiration. Well, to me, that doesn't give me enough time. And what I have found in research is that the farther out you go in time, 60, 90, 120, 150 days, the difference in the implied volatility, or where the market thinks the stocks could potentially move up or down to, is usually way more than the realized volatility, or what it actually happens to the stock. So the farther out you go in time, the more chances, and there's the market bell for the day, the more chances there are that you're not going to go to those far swings that the market is guessing are going to happen out in time. The closer you are, 30 days, 45 days, what I've found is it's completely upside down. The implied volatility, or the swings that the market's predicting, are sometimes often less than the actual swings that happen in those closer term options. So the farther you go out, the safer the trade and the better chance you have to win, because the markets are thinking the swing is going to be more wild than it actually is. Okay. Number three here, the premium collection. We collect premiums from selling both the call and the put options. So you get to collect two different premiums, not just one here, but we're premium collectors. We are theta traders. Okay. We're getting money paid to us, and we're letting time decay be on our side, as opposed to buying an option where we're paying that premium to someone else. I want to be the seller of premium. Okay, I want to be the house that you have to buy from. Okay, and the last thing here is profit potential. If the market price stays within the range of the two strike prices, both options will expire worthless, which would allow us to keep all of the profits there. However, for me, I'm going to close these trades early. I'm not going to wait till expiration. I don't want to see what's going to happen way down the road. As soon as I hit a 50% profit margin, I'm out of the trade. Okay, so as soon as my premium capture is 50%, I'm out of the trade. And I'm usually out pretty early. My typical trades are out in under 30 days on average. Yep, under 30 days. Even though I'm farther out than everyone thinks you should go at 45 days and staying in the trade for 21 days, I'm in the trade for maybe 28 to 30 days sometimes a little longer, sometimes a little shorter. I think my shortest trade this year was 6 days in a strangle. Okay. And the average longer ones, maybe about 40. I'll show you a little bit more detail on that as we go. However, I'm going to take profits early so I can avoid potential swings that could happen after that. I want to get my profit and I want to take it and run. All right. Next thing here, let's talk about some of the benefits and risks of strangles. Okay. Number one, benefits. Okay. We get income from premiums. The main profit comes from the premiums collected. We're going to be paid to put these trades on. Okay. So the benefit here is we get paid to put trades on. Number two, we profit from stability. Ideal for the markets is to, is to remain within that specific range. So it's ideal for us that we just stay within a range. And I'm going to show you a good example of how we kind of pick those ranges. And then lastly, limited upfront costs. Unlike buying options, selling options involves collecting premium instead of paying somebody for those premiums. Yes, it's still going to use some buying power, but I'm not out of pocket anything to start this trade. I'm actually paid, and now I'm going to keep a portion of what I was already paid. All right, number two, let's take a look at some of the risks. There are risks involved. When you're selling naked puts or naked calls, which means you don't own the underlying stock, okay, there's unlimited potential for loss. If the market moves significantly outside of those strikes, the losses can be substantial. Okay, number one. Number two, margin requirements. Selling options requires maintaining a margin account with sufficient funds to cover any of those potential losses. And then the third piece here to worry about really is market unpredictability. Okay? Unexpected volatility can result in significant losses. If the volatility goes through the roof, you can start to see some losses. What's going to help mitigate many of these risks is just having a trade plan. How, instead of unlimited potential loss, I'm going to stop out when a certain percentage loss is hit. I'm going to size my trades properly so that my margin requirements stay pretty well within my means. Okay? And that if I lose based upon my stops, I'm only going to lose a small percentage of my total account. For me, it's usually maybe 2% of my account if I would lose a trade. More than often, it's less than that. It's probably closer to 1.5% of my account on any one bad strangle trade. Okay? And then lastly, market unpredictability. I want to try to identify stocks that are not trending in a good sideways setup. Okay? Doesn't mean they can't move, okay? But I want to give myself the best chance to be successful. Okay, hope this makes sense. All right, so here's some key insights for you. Successful strangle selling requires meticulous analysis and timing. It's not just about looking for an asset with implied volatility. In fact, I'll go so far as to say that the higher the volatility, the riskier the trade. You got that right. The higher the volatility, the riskier the trade. Okay, do I want to trade something? Is a good example. Do you want to try to approach the crazy person at the bar who's been drinking heavily for 6 hours and is super volatile, could go off at any second? Or do you want to spend time talking to probably the more calm, good-looking person over here that is not going to potentially go off on you? Okay? You want to find those stocks that aren't subject to those crazy swings and aren't already doing something crazy to increase the volatility. I don't want to sell naked puts and calls on an asset that's highly volatile and can potentially make large swings. I know that's counter to some people out there that are thinking, well, you want to sell higher volatility. Not really for me. Okay? I don't want to sell minuscule, but I still want to sell calm volatility. I don't want things moving up and down like crazy. Okay, so I don't need an ultra volatile asset. Okay, you have to put the odds in your favor by doing a bit of technical analysis before placing the trade. Okay, that's going to help you ensure success a little bit more. Does it eliminate all risks? No, it does not. However, doing a little bit of technical analysis before placing the trade is going to give you a better chance of winning. And again, the goal here is to put yourself in the best chance to be successful and let the odds play out. All right, so let's take a look now, okay, at a trade that I did in the Aussie dollar, right? So look at the Australian dollar Forex and Forex on futures. We're going to take a look at this trade. So let's look at the current trade where I leveraged selling a strangle to capitalize on a stable market and achieve some pretty impressive results. In this example, okay, as always, it hits a 50% winner, as always for winners, okay, 50% winner. Okay, it wasn't, it was actually 40 days in trade, so 40 days in the trade, not 4 here, so we'll get that corrected. In fact, I'll make sure that I do it right now. So 40 days in the trade, which is all good. So I like the fact that it was 40 days in the trade on this particular trade, close to my 30-day average. We returned 24% return on margin for this trade, which is a 219% annual percentage rate. Okay, I'm not going to post this video on YouTube and say, hey, I'm going to give you a strategy that returns 200% a year. It's a little misleading, okay? Yes, technically that is the annual percentage rate, but it's returning 24% in 40 days, okay? I think that's pretty doggone good. All right, so let's jump into it. I'm going to share my screen, and let's take a look at some of the technical analysis that we used to put this particular trade on. All right, so let's take a look. We've got our charts set up here for the Aussie dollar, and taking a look at what's going on back here. And I'm going to zoom in a bit on this particular trade. And you can see these yellow lines up and down here, the 2 yellow bars. And hopefully you guys can see this okay. That's going to be the length of time that was spent in this particular trade. All right. So what I did here is I noticed, look at this sideways action, just trending side. This is a weekly chart on the left and a daily chart on the right. Look how calm and sideways this thing was behaving. Perfectly set up for what I'm looking for. I have a couple technical indicators that I use to really help me with Strangle profitability. Okay. Come and join our Discord, find out exactly those specific setups. But you can see here that this is a pretty calm looking underlying. And if we even look at the daily here, you can see this thing was just moving sideways. The weekly is where I like to look. Okay. Number one, because I'm trading longer term, 60, 90, 120 days. I like something closer to that 90-day mark. So that's where I'm trying to stick around for the most part. So the weekly gives me the best chance to be successful when I'm looking at everything for a trade that's longer term. Well, let's take a look now on the daily side of things. What I did here was back here on the 26th, okay, I sold where we were dead center here. Okay, I sold the strike up here at 0.705. Okay, that was the upper end of this range for the calls, and then I sold the put down here at 0.6. Okay, that's the Aussie dollar pricing. So this is where I sold the calls up here in yellow and the puts down here in yellow. As long as this thing stayed within these 2 lines for the duration of the trade, I was going to win and I was going to make money. Okay. So as the market did stay between these 2, the trade hit 50% winner in 40 days, which is the length of this line. You can see that from here, when we placed this trade, we were trading somewhere in the neighborhood of, maybe 0.65. And when we closed this trade here, we were trading at 0.667. Okay, so very little movement at all on this particular trade. Okay, 24% on margin used, 40 days in this particular trade. Okay. This gives you everything that you need to know, that if you can find something trending sideways, which is not really a trend, so really no trend here, looking pretty calm on the weekly, okay, looking pretty calm on most of the technicals, so you don't see any giant wild swings on, RSI or MACD or either one of those. Okay, moving averages are pretty flat, and you're just hugging the 21 in green and the 50 in pink here. you're just hugging those moving averages. You're not swinging wildly above and below. I think that sets up well for potential trade in this. All right, so what do I like to trade? I love the commodities market. So commodities like gold, silver, ag products, copper, they can often experience periods of stability, making them ideal candidates for selling strangles. Okay. Also, most commodities are range bound most of the time, unlike stocks. Stocks tend to do what? Go up over time. Okay, sometimes violently up, sometimes violently down, but for the most part, they tend to just increase in value over time. Commodities do not. Those prices can change over time, but they typically will stay in a range. If you looked at oil, and we can go back and take a look at a chart on oil, for the most part, let's go back and take a quick peek at what oil is doing, and let's go to a monthly chart on oil. I mean, for the lowest we got here was about 20 bucks, and the highest we got here was about 120 bucks. So it stayed in this 100-point range, but really, since 2021, oil has been between 47 and about 115. Okay, so it stayed in that range, and if you look at the last 2 years, oil has ranged from essentially 90 to 65. Super tight on oil. If we look at the Aussie dollar, same thing. Look at this. Go back a couple years, and this thing has ranged from about 0.62 to about 0.71. Look how flat that is. Okay, perfect setup there. Now if we look at the ES or the S&P, you can see that this thing has just continually moved up over time. Yes, a couple periods of down and then back up. Over time, though, this thing has moved from a low of about 2170 all the way up to 54.54. Okay, it's doubled in price in that same time. Whereas oil, just oscillating back and forth. Not up, not down. Okay, some periods going either way. Bonds, for the most part, have been in a decline for a couple of years now, but really even bonds, if you look at the last 2 years on bonds, we've been moving from about 135 to about 107. It's only about a 25 tick range on bonds. Also not too shabby. If we look at gold, okay, going back all the way to 2019, gold has ranged from about 1691 to about 2083. So not a bad range in here. More recently, gold has started to take off. So commodities can be a fantastic trading vehicle for you. All right, so here, to sum it up for you, selling strangles on futures opens a world of opportunities for traders to maximize their income. So by understanding the mechanics and intricacies of this strategy, you can navigate the markets with confidence and boost your profits. Some key takeaways for you here. Number one, selling strangles benefits from market stability. It doesn't have to be a high volatility asset. I'm going to repeat that. You don't have to search for high IV products. In fact, low IV products work even better, in my opinion. The only difference is you might receive a little less premium in exchange for a calm ride. Okay. Understanding the mechanics and costs is crucial. So make sure if you're going to put on strangles, you understand the mechanics and the costs involved. Okay. Successful execution requires meticulous analysis and timing. Take a look at the charts. What are you seeing? Take a look at a few indicators, come up with good candidates, okay, but be patient. Don't try to force it on gold or something else just because gold's in the news. Look for something that's pretty much just moving sideways or a good spot sideways, looks fairly calm. Give yourself a little bit of an edge here. Probabilities are still going to be the same. If you're selling 10, 9, 8, 7 delta, puts and calls, you're still going to have a 90% win rate, and you're going to be pretty well out of the money on those. Right? So the probabilities are going to give you the best chance to be successful, and you can help those out by picking an asset that's not trending strongly. Okay? And then lastly here, have a plan and stick to it. Okay? It's going to greatly enhance your probabilities. Got to have a plan. You got to stick to that particular plan. Okay. All right. So if you found this video helpful, click the like button down below and make sure to subscribe to our channel for more trading tips and more strategies. I'm telling you, the Strangle, one of the best strategies out there. If you found this video helpful, click the like button down below. Don't forget to explore my other videos on advanced trading techniques that'll help your skills get to that next level. If you're not subscribed, subscribe to the YouTube channel. And there you have it, folks. Get ready to elevate your trading game with selling strangles on futures. One of the best options that you'll have to give yourself consistent income. Stay tuned for more valuable tips. I hope you enjoyed this video. We'll see you guys in trading. I want you to stay safe. Bye-bye.